As Roundtable, well, of course, we've been talking about the markets in the week gone by, but let's tell you what to expect in the week to come. Q2 earnings will be the big talking point, and Nimesh has walked across to the big wall to tell us what to expect this time around. Nimesh.
Well, Sonia, it's going to be very, very hectic for the next 4 weeks for us as we look at the earnings season. And, look at the calendar for next week itself. It's going to be a hectic next week to start with TCS on October 10th. Then we have Delta on October 11th, HCL Tech and Wipro, both from IT on October 12th. We have Infosys and Mindtree on 13th. We have Bajaj Auto and Tata Elxsi on 14th. And even on a Saturday, it's going to be very hectic with Avenue Supermart, HDFC Bank, ICICI Pru Life and L&T Infotech all reporting on the 15th. So it's going to be quite hectic to start with the next week. Now, I've just looked at the overall earnings preview of a lot of the brokerages. So here's the summary of Q2. The potential leaders are going to come from BFSI, consumers and autos. They are expected to report strong numbers, whereas laggards is going to be from metals and oil and gas. They are going to disappoint. So I've looked at the individual sectors now. The first is technology, because they are going to start first. It's going to be a mixed bag for technology, but it's not going to have a big impact on the FY23 and FY24 EPS estimates. That's the overall consensus. The growth may slow down in FY24 estimates, but it appears to be price change. So there's not going to be a big scare. However, the risk is the recession, the deep recession in US and Europe. So that's for the IT sector. Now coming to the banks, because that's a big sector. Within the banking sector, I think the big theme is the credit growth and NIMs are showing resilience and liabilities are gaining focus. But the biggest surprise in terms of positive surprise will come in the private banks. The PAT growth, the analysts are expecting a 53% growth YOY. So that's on private banks. On NBFCs, the growth is picking up. So even there's going to be no big negative surprise. Even for housing finance companies, there's going to be a strong individual disbursement for the HFC. So that's going to be clean. And for the insurance companies, there's going to be some moderation in terms of the VNB margins compared to the Q1. So there's going to be a small disappointment on the insurance. Coming to the auto sector now, again, that's going to be a big sector and it's going to outperform. So sequentially, it's going to be an improvement in the margins. Q3 is going to be the best quarter in terms of recovery from the input cost, which was hitting them. So CLS has put out a note, and they believe that in Q2, the biggest EBITDA, highest EBITDA margins will come for Ashok Leyland and Maruti. So they too are going to outperform as far as the autos are concerned. Now coming to the cement sector, it's going to be a washout sector for cement in Q2, but that looks like it's in the price. So the profitability will be at a multi-quarter low in Q2 for most of the cement companies. In fact, Street is expecting the EBITDA per ton to fall by 50% YOY in Q2. Expect margins to recover only from Q3. But again, it looks like to some extent it's in the price. Now coming to the telecom sector, it looks like it's a stable quarter for telecom, limited surprises. 5G is going to be the next big trigger. For Bharti Airtel, it's going to be a slight increase in the ARPU. But for Vodafone India and Indus Tower, that's going to be a tepid quarter. So that's going to be for telecom. Now looking at the paint sector, that's going to again report a very strong quarter according to the brokerage. So demand is quite buoyant. There is a festive cheer as well. And Macquarie believes that Asian Paints is going to lead the paint sector. So that's with the paints preview. If you look at the fintech companies, now I picked up for a specific reason. It's going to be a steady quarter for fintech companies. Paytm across the board, there's going to be a good momentum. For PB Fintech, again, sustained growth. But for all these companies, the lock-in opens in November, and that's going to be a big overhang for all these stocks. So fintech largely on the lock-in overhang will be key to watch out. So as I said, it's going to be a mixed quarter for Q2. No big surprises, but I guess individual sectors will be very important as far as reactions are concerned.
All right, Nimesh, thanks very much. That's very exhaustive and very interesting, especially the last fintech bit. Ashwini Agarwal is now joining us. He's founder and partner at Demeter Advisors. He's in our studios. Ashwini, great to have you with us here.
Thank you. Thanks for having
me. In this unseasonal rain. You weathered the rain, and so thank you again. How are things looking, Ashwini? You've been a bit cautious overall because of valuations and where they've been.
Yeah.
Are you still a little apprehensive of how far this can go?
Yes, because the world is in a very uncertain place. Earlier this week, for example, everybody is expecting the US Fed to pivot, but there is no sign of that happening. I think the risks have increased with oil prices going up. So the world is in a very, very uncertain place. And as to what Nimesh was alluding to earlier, the focus is going to be on quarterly earnings next week onwards. And I expect the earnings to be not as good as what the market is hoping for. And I would focus a lot more on the commentary than the numbers themselves. And I think the commentary could be a little soft because at the margin, I see demand trends softening, both export-led as well as domestic. So I am a little cautious. I continue to be a little cautious. Obviously, one is hoping that one doesn't have a big accident either in India or anywhere else in the world because of the different forces that are pulling us apart as a market. But even if an accident doesn't happen, I see very limited room for a broad-based upside from here.
So would you extend that caution to sectors like, say, IT? Because the writing is on the wall, right? I mean, there are margin pressures. Perhaps heading into a recession, there could be a crunch in client spends as well.
Yeah.
Do you think the worst is in the price, or could there be more to go?
I think a lot of the bad news is in the price. So that's one area where, I've been struggling with, where, I've been negative for a while. Stock prices have come off. These are best of breed companies in terms of governance, in terms of cash conversion, in terms of dividend yields. So at some point, they'll become a buy. Now, whether it's 5% down from here, 10% down from here, I can't say. But this is an area where I would be looking at the earnings very, very closely, at the commentary very, very closely. And if companies are confident about the next few quarters and coming through without too much of a trouble, I think they would be a buy. So that's one area where I'm looking for an opportunity to invest. Not right away, but maybe 5-10% lower.
Okay, Ashwini, good evening. What's happening with the liquidity front? Because our market has been supported a lot by domestic liquidity. I mean, if this was a market of 2008, it would have collapsed, right? But the domestic fund sort of prevented that. The FI money is coming, but it's not coming in the kind of numbers that we used to see. It's still, on and off.
That's right.
What's happening here?
Well, we are a closed box market, right? Most of us can't take out much of our money outside. So we are, forced to invest in the local market. And if you look at the size of the household savings, and even if you were to make very, very small allocation assumptions towards equities, you can easily make a case that $2 to $3 billion every month can continue to flow into India. And that's really India's story from a downside protection point of view. So I don't see that changing. The other thing is that most investors have now realized that via mutual funds or even via direct equities, if you're willing to look past speed bumps, this is an asset class that gives you great returns. Over the last 20 years, it might have been 18 to 20%. Over the next 20 years, it might be just 10 or 12%, but 10 or 12% is still much better than 5 or 6% that you would get in any alternative fixed income securities. So my sense is that this allocation towards equities will continue unless there is something that causes everybody to become very scared. And that would be an accident, of the sort last weekend, for example, there were a whole bunch of these news articles about a large Swiss bank, Credit Suisse. If something along those lines happens, then all bets are off. Then, you will go through, one big sort of a scared sell-off, a scary sell-off. But that would be, again, an opportunity to buy. And that's what people have realized, that, whoever bought in the COVID fall made pots of money, and that's why those steep falls don't happen.
Ashwini, what about financials? Because even as I pointed out, that's one space which is in the sweet spot. The private banks are going to report 30% of 30-35% YOY PAT growth. What's your view on the financials now?
I think great place to be across the board, because you're coming out of a 10-year slow cycle. So your economy is expanding. Inflation is helping credit growth. There is working capital expansion that has happened because businesses started to grow. Companies are willing to invest. So my sense is credit growth, asset quality, margins, everything is at a sweet spot. And again, it's a question of what happens to rates. I think, we will just muddle through with maybe 25 basis points here or there on the 10-year government yields. So if that assumption holds true, you don't have much of a downside on the fixed income book either. So there's really nothing to not like about the banks at this point in time. So I mean, that's one area where, I think one should be very, very positive.
I think Anuj pointed out that data, right? I mean, the only large group, financials, down 16% from its 10-year
has a discount compared to its 10-year average.
That's right. The value is still there in the sector.
Okay, well, that's what we want to know. I guess that's what our viewers want to know. But in case we don't speak before Diwali, greetings of the season to you.
Same to you and to your viewers.
This has been a good one, right, for everyone. As you said, people who had invested in the COVID dip would have made pots of money. I hope they continue to do so. With that, though, it's a wrap on this edition of Editor's Roundtable. Thanks a lot for watching, and you folks have a great weekend.